Your accountant could be making a mistake that will cost you tens of thousands of dollars. If an organization qualifies for the employee retention credit, they can get a special one-time tax credit payment, which is based on their payment of qualified wages, health plan expenses in 2020 and 2021. And the most common mistake that I see organizations making is leaving that qualifying determination solely in the hands of their accountant or CPA. What's at stake? Based on my experience as a referral partner with the world's leading independent consulting firm filing for ERC, the average payment for qualified organizations is around $10K per W-2 employee. If an organization has 5 W-2 employees, that's a $50,000 refund pay. 50 employees would be $500,000. 150 employees would be $1.5 million. So the company I'm affiliated with, Bottom Line Concept, one of the first, and I believe the best company specializing in filing for ERC, has gotten over $4.5 billion ERC credit for over 25,000 companies. My point is, ERC is real serious money. So determining whether or not your organization actually qualifies is critical. So there's some types of businesses that are almost a slam dunk as far as qualifying for ERC if they had at least 5 non-family member W-2 employees. So that includes gym, restaurant, veterinary practices, and medical practice. When I ask an owner or officer on one of these types of businesses, and I know they have more than 5 employees, did you file for ERC? And they say, what is ERC? I know there's a problem. It's the same story if they say, my accountant told us that we don't qualify for ERC. They're assuming that if they're qualified, their accountant or CPA would have absolutely positively filed for the credit for their organization. But I know there's an extremely high probability that their accountant has made a mistake and is going to cost that organization a lot of money if they don't take action to correct that mistake. And this doesn't mean that their accountant is incompetent. ERC is complex. Unlike PPP, it was never widely publicized, and the rules have changed significantly over time. It's a new one-time program, so many accountants won't have a lot of in-depth experience with it or necessarily have the time to drill down into all the nuance. Often their accountant is basing their evaluation on the lack of a decline in gross revenue, may not be considering the qualitative aspect of eligibility. It's a gray area. It's based on facts and circumstance and was not part of the program when it was first rolled out. It's plausible that an accountant may only be considering whether or not there was a 50% decline in gross revenue as the sole means to qualify. This program was originally created this way, but it was significantly updated in March 2021, and news of this largely flew under the radar. The gross revenue decline was reduced to 20% for quarters 1, 2, and 3 of 2021, and a second way to qualify was added: full or partial suspension of operations. So many people are still learning this news today and have not done enough due diligence on the nuances and complexities of this way to qualify. So meeting the eligibility requirement for a partial suspension is based on a set of determining factors, and this leaves uncertainty for many accountants. Accountants typically rely solely on quantitative data. They require hard numbers to reach conclusions, and this is an excellent quality in an account. But this is why they may only consider decline in gross revenue qualification and ignore the newer additional way to qualify. The partial suspension is based on facts and circumstance and meets the eligibility requirement through a qualitative set of data rather than quantitative. An accountant may be much less inclined to navigate this area since it's not supported by hard quantitative data. They may prefer certainty of numbers over a case narrative, but it's only through this case narrative that a business can legally and ethically qualify for this new second qualifying. So back to the if we qualified, our accountant would have filed for a conversation. Usually the person I'm talking to will say, talk to my accountant, and I tell them, you absolutely should. But before you do that, you should invest 15 minutes in a no obligation, no cost phone call with one of the ERC specialists at Bottom Line Concept, so that you can be fully informed before you talk to your accountant. The ERC specialists at Bottom Line do ERC all day, every day, and have been doing it for years. And one of their specialists can walk you through a structured Q&A session in 15 minutes and tell you whether or not you qualify and why. Or you could bring your accountant on call with you so they can hear the information directly. So if you are a U.S.-based company or organization that was in business on or prior to February 15th, 2020, had 5 or more W-2 employees during COVID, suffered a financial impact due to COVID, or had to make operational change for business because of it, it would be well worth the investment of 15 minutes of your time for a no obligation phone call with an ERCA to help you assess and determine whether or not your organization actually qualifies. So I'll put the link to do that in the description of this video. Hit that link to find out if your business or organization has many thousands of dollars coming